Welcome back to our channel, where we discuss important financial topics to help you make informed decisions. In today's video, we'll be talking about recessions and how to navigate through them. So, let's dive in. Point 1. Historical perspective. Did you know that the average post-World War II recession lasted about 10 months? According to an article from Forbes, recessions have become shorter over the years. If we look back even further, from the 1850s until now, the average recession lasted around 17 months. The reason for this decrease in duration can be attributed, at least in part, to the creation of the Federal Reserve Bank in 1913. The Federal Reserve, also known as the Fed, has the power to manipulate our monetary supply by printing more money or cutting interest rates. These measures help stimulate and influence the economy, especially during recessions. However, it's important to remember that recessions are unpredictable. Even though the Federal Reserve Bank is currently predicting a recession by the end of 2023, nobody can perfectly forecast when a recession will occur. Often, recessions catch us by surprise. While we may be seeing red flags in the economy, the actual impact of a recession might not be felt until later. That's why it's crucial to pay attention to what's happening and be prepared. So, let's take a closer look at the history of recessions. In 1945, we experienced a recession that lasted 8 months. Then, in 1949, it lasted 11 months. Moving forward, in 1953, a recession lasted 10 months, followed by another 8-month recession in 1958. In the 1960s, we saw recessions lasting 10 and 11 months, respectively. In 1973, a recession lasted 16 months, and the same duration was observed in 1981. In 1990, we had an 8-month recession, followed by 8-month recessions in both 2001 and 2008. Most recently, in 2020, we experienced a 2-month recession. As you can see, recessions have occurred throughout history. While there's ongoing debate about whether we'll witness another recession, it's essential to acknowledge that they are a part of the economic cycle. Understanding their duration can help you better manage and invest your money. Point 2. Recession indicators. Now that we've looked at historical data, let's explore some recession indicators that economists often consider. One commonly used indicator is the Warren Buffett indicator. This indicator examines stock valuations. When stock valuations rise significantly, it suggests a potentially overheated economy, indicating an impending recession. The higher the valuations, the more likely it is that the economy will need to cool down. Another indicator is the yield curve. The yield curve compares the rate of return for lending money to the government for different periods, such as 2 years and 10 years. Normally, longer-term investments should yield higher returns due to increased risk. However, when the yield curve inverts and short-term investments offer higher returns than long-term ones, it can indicate concerns about the long-term health of the economy. This inversion is considered a recession indicator. Remember, these are just a few indicators among many used by economists. Regardless of the specific indicators, recessions ultimately share common factors. They occur when people and businesses experience a reduced ability to spend money, which has a cascading effect on the economy. Point 3. The role of spending in recessions. Let's now delve into the relationship between spending and recessions. Our economy thrives on spending, as consumer spending accounts for a significant portion of the overall economic activity. During a recession, one of the primary factors contributing to the downturn is a decline in consumer spending. When people face economic uncertainty or job losses, they tend to cut back on their discretionary expenses, such as dining out, travel, and luxury purchases. This reduction in spending has a ripple effect throughout the economy, affecting various industries and businesses. As consumer spending declines, businesses experience reduced demand for their products and services. This, in turn, leads to lower revenues and profits, forcing them to make adjustments to their operations. They may lay off employees, reduce production, or even close down entirely. These actions further contribute to the economic downturn and create a cycle of reduced spending and contraction. Additionally, during a recession, businesses may face difficulties in accessing credit and obtaining loans. Banks and financial institutions become more cautious about lending due to the increased risk in the economic environment. This limited access to credit can further constrain business activities, hindering investment and expansion plans. It's important to note that government spending also plays a crucial role during recessions. Governments often implement fiscal policies, such as increased government spending or tax cuts, to stimulate the economy. By injecting money into the system, governments aim to encourage consumer and business spending, thus boosting economic activity. However, individual actions also matter. During a recession, it's wise for individuals to assess their financial situation and make necessary adjustments. This might include cutting back on discretionary expenses, creating a budget, and building an emergency fund to weather financial uncertainties. By being proactive and making informed financial decisions, individuals can navigate through a recession more effectively. Point 4. Investment strategies during recessions. While recessions can be challenging, they also present opportunities for investors. It's important to remember that the stock market tends to experience volatility during recessions, with significant fluctuations in prices. This volatility can create opportunities for long-term investors. One strategy to consider during a recession is to maintain a diversified investment portfolio. Diversification helps spread risk across different asset classes, such as stocks, bonds, real estate, and commodities. By diversifying, you reduce the impact of any single investment's performance on your overall portfolio. It's also crucial to review your portfolio periodically and make adjustments based on your risk tolerance and investment goals. Another strategy to consider during a recession is value investing. Value investors look for stocks that are undervalued compared to their intrinsic worth. During a recession, the market sentiment may push stock prices down, presenting opportunities to invest in quality companies at lower prices. Conducting thorough research and analysis can help identify potential undervalued stocks. Additionally, consider the long-term perspective when investing during a recession. Recessions are temporary periods in the economic cycle, and history has shown that markets tend to recover over time. It's essential to focus on your long-term investment goals and avoid making impulsive decisions based on short-term market movements. Lastly, it's wise to consult with a financial advisor who can provide personalized guidance based on your individual circumstances and goals. They can help you navigate through the complexities of investing during a recession and assist in developing a comprehensive investment strategy. In conclusion, recessions are an inherent part of the economic cycle. While their occurrence is unpredictable, understanding historical patterns, recession indicators, and the relationship between spending and recessions can help you navigate through these challenging periods. By being proactive, making informed financial decisions, and considering investment strategies tailored to your goals and risk tolerance, you can weather the storm and potentially find opportunities for long-term growth. Thank you for joining us today. If you found this information helpful, make sure to check out our other episodes for more valuable insights. Remember, knowledge and preparation are key to successfully navigating through recessions. Take care and stay financially resilient.